In this video lesson, we'll be breaking down the 4 most common trading styles. Each is unique and effective. However, you'll find the trading style you ultimately choose will most likely be directly correlated to the time and effort you are willing and able to devote to trading. Scalping and intraday trading are considered short-term trading styles, while swing and position trading are known as more long-term trading styles. Obviously, if you don't have the luxury of being able to trade every single day, especially during the open and close of the markets, short-term trading will most likely not be suited for you. Instead, swing or position trading would be more feasible, as both, in general, require less time dedicated to the markets. While the actual trading strategies are very similar across all 4 styles, the average time spent in a trade and the common charts used for each trading style vary greatly. First, let's discuss scalping. This style is known as the quickest form of trading. Trades can last as short as a few seconds to as long as a couple of hours. With this style, traders attempt to profit on any and all moves in the market. As a result, traders can produce profits greater than a point, but often capture much smaller moves, sometimes as little as 5 to 10 cents. While these moves are often tiny, especially in comparison to moves produced from other trading styles, the losses incurred by scalpers are much smaller as well. Furthermore, traders often take much larger positions as a result of the smaller gains and losses. Typically, scalpers rely on momentum and look for volatility, as this style suits quick changes in either direction. A scalper predominantly uses 1 to 2 minute charts when trading. Some key advantages scalpers have are as follows. 1. They typically have a higher percentage of winning trades compared to any other style. 2. They have a minimal amount of risk per trade. 3. Scalpers are able to find numerous trading opportunities each and every trading day. 4. They're able to capture quick moves and changes in trend. 5. All trades a scalper makes are during trading hours, so there is not any overnight risk. And 6. Scalpers do not have to pay much attention to fundamental analysis, as it is not relevant due to the short time spans they are in trades. Now, some of the key disadvantages scalpers are faced with include: 1. There is a high amount of emotional and psychological pressure on the trader to make split-second decisions. 2. Due to constant nearsighted bias, scalpers often prematurely exit, missing the total move on a trade. 3. An advanced trading platform, computer, and internet connection is needed, as speed of execution is absolutely critical with this style. 4. Scalping involves continuous focus on the markets, especially during the open and close of the trading day. 5. Scalpers run the risk of turning or overtrading, which can dramatically lower reward to risk ratios. And 6. Due to the high frequency of trades, scalpers incur high transaction costs. Next, we have intraday trading, also known as day trading. This style of trading involves trades that are opened and closed during the trading day. With this style, traders attempt to capitalize on the overall trend of the day. Typically, trades last from a couple of minutes to the whole day. Trades often require slightly more risk than trades placed by scalpers, but also produce bigger gains. However, intraday trading is similar to scalping in that fundamental analysis does not play a part in most decision-making. Moreover, intraday trading, though not as intense as scalping, requires constant attention during the trading day. Intraday traders typically use a 5-minute to 30-minute chart. So for intraday traders, some key advantages include: 1. An improved reward to risk ratio compared to scalping. 2. intraday traders have a greater potential for big gains compared to scalpers. 3. They are able to capture the majority of the daily move in a stock. 4. Just like with scalping, intraday trading has no overnight risk, as all positions are exited by the close. And 5. Fundamental analysis is not a major factor for intraday traders. Now, some of the key disadvantages associated with intraday trading are as follows. 1. Like with scalping, there is some degree of emotional and psychological pressure to make quick decisions on entries and exits. 2. Intraday trading requires a level of discipline as reward to risk ratios must always be top priority. 3. Intraday traders can be whipsawed or stopped out of a big move due to volatility even though the correct trend was identified. And 4. A decent trading platform is needed to execute at various important entry and exit points. Moving on to swing trading. This is undoubtedly the most common style new traders use for better or for worse. This is because it suits the lifestyle of those traders who care to participate in the markets but have other responsibilities such as another occupation. Trades placed using this trading style often last anywhere from 2 days to a week, an attempt to capitalize on the predominant weekly trend. Consequently, trades do not require as much attention as monitoring of target prices and exit points can be done periodically. Swing traders typically use longer interval charts, such as a 1-hour chart along with a 5-minute chart. Moreover, while swing traders require more risk than both scalping and intraday trading, they also produce higher returns. When swing trading, fundamental analysis does play a factor into decision making, as well as any announcements, news, or economic data that may affect the direction of a move. Some key advantages swing traders have are as follows. 1. They have an improved reward to risk ratio compared to intraday traders and scalpers. 2. Swing traders have a greater potential for big gains compared to intraday and scalping. 3. They're able to capture the majority of the weekly move, not just the daily move. 4. Swing traders have a low degree of emotional and psychological pressure as the decisions are not as time sensitive. 5. Swing trading is less affected by intraday market action. 6. They have low transaction costs as they have a lower frequency of trades. 7. Swing traders only need to monitor positions periodically. And 8. Most trading platforms, computers, and internet connections are suffice for swing traders as speed of execution is not as important. As far as disadvantages associated with swing trading, they include 1. Overnight risk, as swing traders often hold positions a few days. 2. Swing trading requires extreme discipline, as reward to risk ratios must always be top priority. 3. A high level of patience is required when using this style of trading. 4. Swing traders have a low percentage of winning trades. 5. Due to a longer-term bias, they usually are unable to capitalize on short-term moves. 6. Swing traders stay abreast of any announcements, news, or economic data that may affect the current trend. And finally, there's position trading. This should not be confused with investing. Position trading takes extreme patience as trades last anywhere from a few days to several months. With this style of trading, once target prices and exit points are put in place, traders can monitor positions when available. Position traders use both technical and fundamental analysis when determining when to enter and exit trades. Moreover, there is considerably more risk involved, but with that risk, the potential for gains are too exceedingly higher compared to the use of any other trading style. Traders who position trade typically use daily charts, but can use smaller interval charts as well, such as 1-hour charts, to get a closer look at most recent activity. Some key advantages position traders have are as follows. 1. Position traders have an improved reward to risk ratio compared to swing, intraday, and scalping. 2. They also have a greater potential for big gains compared to swing, intraday, and scalping. 3. Position trading captures the majority of a long-term trend. 4. There is a low degree of emotional and psychological pressure, as decisions are not as time-sensitive when trading with this style. 5. Position traders are likely not affected by any particular intraday market action. 6. Position traders have very low transaction costs. 7. They have the luxury of monitoring positions periodically. And 8. Most trading platforms, computers, and internet connections are suffice when position trading, as speed of execution is not as important. Some key disadvantages associated with position trading include 1. Overnight risk, as position traders can hold positions for weeks and months on end. 2. Position trading requires an extreme amount of discipline, as reward to risk ratios must always be top priority. 3. Position traders must have a very high level of patience. 4. They have a low percentage of winning trades. 5. Position traders are unable to capitalize on short-term moves. 6. They must stay abreast of any announcements, news, or economic data that may affect current trend. And 7. Position traders must factor in fundamental analysis as well as technical analysis in their decision-making. So which trading style is the best to use? Well, success can be found using any of these styles. However, you'll gravitate towards the trading style that suits your lifestyle best. Moreover, your personality, resources, needs, and time all should be considered when deciding which style of trading to pursue. If you are able to dedicate ample time to the markets and have a desire to be involved every single trading day, then short-term trading most likely suits you best. However, if you are preoccupied with other tasks during the day and have the ability to practice solid discipline and patience, then a long-term trading style will be more adequate for you. Moreover, if you like to base trades heavily on fundamental analysis, then a long-term style such as swing or position trading would better suit you, as it often takes a long time for fundamentals to affect price action. Ultimately, as traders gain experience and confidence, traders often implement a combination of styles. It is common to see an experienced trader use any of these styles we discussed interchangeably, depending on the market conditions. Keep in mind, the most important thing is that you are comfortable with the trading style you choose and are aware of the advantages and disadvantages that are associated with it. Your probability for success is inherently increased when using the trading style that suits you best.